Hello, everyone. Welcome to the weekly lecture videos. This is the second video of chapter 13. And in this video, I'm going to discuss the capital structure theory in covering the second learning objective, where we discuss the impact of taxes and bankruptcy on capital structure choice. So first of all, if you can recall from the last video, we have seen that there is nothing special about corporate borrowing because investors can borrow or lend on their own. As a result, whichever capital structure a company chooses, the share price will be the same. Okay, so capital structure decision therefore is irrelevant, at least in the simple world that we have examined in the previous video. Now, the Eagles Air Service example that we have seen in the last video is based on a famous argument advanced by two Nobel laureates, Franco Modigliani and Morton Miller, which are popularly known as MM. We will illustrate this Eagles Air Service capital structure is a special case of MM Proposition 1. Okay, so MM Proposition 1, here I am, MM Proposition 1 states that how a firm chooses to arrange its finances is completely irrelevant. Okay, so we will discuss this MM Proposition 1, the pie model, in the next slide. But at this moment, just let's understand that a firm's value, that means the market value of a firm, is independent of its capital structure. Why is so? This is because, as we have discussed previously, that individual investor can change their capital structure, okay, can change their capital structure decision. That's why what an investor can do by him or herself, a firm cannot expect to have an impact on the share price by taking that decision in their capital structure choices. Okay, so MM Proposition also has a second part, which is called MM Proposition 2. And it states that cost of equity capital is a positive linear function of capital structure. Okay, so what does it mean that a capital structure is positive linear function? It means that as firm uses more and more debt, that means debt to equity ratio increases, then its cost of equity will increase. Okay. So MM essentially argue that the firm value is determined by the cash flows of the firm and the risk of the firm's assets. Okay, so it is not determined by their capital structure decision. Okay, so what is relevant for firm value is how risky a firm's cash flows are, and those cash flows are generated by firm's asset. So the risk associated with firm's asset and the riskiness of the firm's cash flow are actually the determinant of firm's value rather than the firm's capital structure decision. Okay, so let's discuss these MM Proposition 1 and MM Proposition 2 in a bit more detail. So one way to illustrate MM Proposition 1 is to imagine two firms that are identical on the left-hand side of the balance sheet. Okay, so left-hand side means the asset side. So their assets and operations are exactly the same. Okay, the right-hand sides are different. Right-hand side means the liability sides are different because the two firms finance their operations differently. Okay, so in this case, we can view the capital structure question in terms of the pie model that you can see here. Okay, the reason this is called pie model because you can see the way they look. So this figure essentially gives two possible ways of cutting up this pie between the equity slice and the debt slice. So you can see in the left, the equity is 40% and debt is 60%, and in the right, we have equity 60% and debt 40%. However, the size of the pie is the same for both firms because the value of the asset is the same. Okay, so this is precisely what MM Proposition 1 states. The size of the pie does not depend on how it is sliced. Okay, so you can see that value of the firm remains the same no matter how you carve this pie. Okay, as we previously argued that the capital structure decision doesn't affect firm's value. Okay, so what determines firm value is the cash flow and the firm's riskiness of the assets. Now, proposition 1 and 2 with no taxes. Okay, although changing the capital structure of the firm may not change the firm's total value, it does cause important changes in the firm's debt and equity. Okay, so let's discuss a little what happens to a firm financed with debt and equity when debt and equity ratio is changed. Okay, you know that from our discussion of the previous chapter, if we ignore taxes, then weighted average cost of capital, that means WACC, weighted average cost of capital, that's what I'm talking about. Weighted average cost of capital is simply the weighted average of cost of debt and cost of equity, right? So if we take this is cost of debt, and this is cost of, this is cost of equity, this is cost of debt, and you know, this is the proportion of equity and proportion of debt. So how we calculate weighted average cost of capital? Cost of equity multiplied by its proportion and cost of debt multiplied by its proportion, and we sum them up, right? So ignoring taxes, the weighted average cost of capital is simply the weighted average cost of debt and equity. Okay, we also saw that one way of interpreting WACC is the required rate of return on the firm's overall asset. Okay, so to remind us of this, we use symbol RA. Okay, so RA, this is the weighted average cost of capital. Okay. So weighted average cost of capital essentially is the return on asset. RA is the return on asset. That's the overall return on the firm's asset. Okay. So if we rearrange to solve for the cost of equity, we see, look at this point, look at this equation. We see that cost of equity essentially equals to the WACC, weighted average cost of capital, or return on asset. Then the difference between return on asset and cost of debt, and the debt to equity ratio. So this is essentially the proposition 2. Okay, so this famous proposition 2 tells us that cost of equity, so this is what I'm talking about, cost of equity depends on 3 things. One is the required rate of return on the firm's asset, which is RA. Okay, and the firm's cost of debt, which is RD, and the firm's debt to equity ratio, which is DE. Okay. Now, probably you understand that, look, the overall cost of capital, which is also the return on asset, if it is higher than cost of debt, what does it mean? It means that you earn a return on your overall asset which is higher than your cost of debt. That means after paying the return back to your debt holders, there is an excess return. Okay, and this excess return goes to the equity holders, and equity holders also get the overall return that is earned on the asset. And that's why you can see that as long as this return on asset is higher than the cost of debt, return on equity is higher than the return on equity will increase as the debt to equity ratio increases. I repeat, as long as this is positive, okay, which means that return on asset is higher than cost of debt, the equity holder will get an excess return. Okay, so that's why the cost of equity will increase as the debt to equity ratio increases. Okay, so these argument summarizes our discussions by this graph. Okay, so you can see here we have cost of equity in the vertical axis and debt to equity ratio in the horizontal axis. So as shown here, proposition indicates that cost of equity, you can see it, the cost of equity is given a straight line where slope is the difference between RA and RD. That means the cost of debt and the return on asset. The intercept corresponds to a firm with a debt to equity ratio of 0. So return on asset equals to return on equity. Okay. This figure essentially shows us, as I was telling you, that as debt to equity ratio increases, it increases the leverage, right? It increases debt. An increase in debt also raises the risk of equity holder, because if you are a shareholder to a company, if the company uses more and more debt, you will feel more risky about your investment. Okay, and that's why you will want more return from the company. That's why the cost of equity will increase, and which is shown by this upward sloping blue line. Okay. So notice in that figure that WACC, weighted average cost of capital, does not depend on debt to equity ratio. It is the same no matter what the debt to equity ratio is. This is another way of stating proposition 1, that the firm's overall cost of capital is unaffected by its capital structure. Okay. So the fact that the cost of debt is lower than the cost of equity is exactly offset by the increase in the cost of equity from borrowing. Okay, so what I'm trying to say is, look, cost of debt is typically lower than cost of equity. Why? Because the debt is less risky from equity from the investor's point of view. So cost of debt is less, okay, than cost of equity. However, as you start using debt, okay, although cost of equity is lower, equity holder feels more risky. That's why cost of equity starts increasing. Okay, so which means that as you start using debt, although you are using a relatively cheaper source of fund, but cost of equity start increasing. That's why overall cost of capital remains the same. Okay, so in other words, the change in capital structure weights, which is the proportion of debt and proportion of equity, is exactly offset by the change in cost of equity. So the weighted average cost of capital stays the same. Okay. So these are the points I just mentioned. Now, let's talk a little about the business risk and financial risk. Proposition 2 shows that the firm's cost of equity can be broken down into 2 components, as we discussed already. The first component is RA, is the required return on the firm's overall asset, and it depends on the nature of the firm's operating activities. The risk inherent in a firm's operation is called the business risk of the firm's equity. Okay, if you remember from chapter 11, we see that this business risk depends on the systematic risk of the firm's asset. The greater the firm's business is, that means if the nature of the business is risky, then the return on asset, RA, which is the required rate of return on the firm's overall asset, will be higher because a firm's overall operation is more risky. And all things being the same, the greater will be the firm's cost of equity. Okay, so if a firm's overall operation is more risky, the firm has a greater business risk. As a result, the overall required rate of return on the firm's asset will be higher. Okay, the second component is the cost of equity. Okay, cost of equity is determined by the firm's financial structure. Okay, that's why we're talking about financial risk, financial structure. For all equity firm, this component is 0. Okay, this component is 0 because as you are all equity firm, you do not have any leverage, so you do not have any risk of possible bankruptcy. As the firms begins to rely on debt financing, the required rate of return on equity rises. This occurs because debt financing increases the risk borne by the shareholders. This extra risk that arises from the use of debt financing is called financial risk. Okay. So the total systematic risk of the firm's equity has 2 parts. One is the business risk, and other is financial risk. The first part, the business risk, depends on the firm's assets and operations and is not affected by capital structure. Given the firm's business risk, the second part is completely determined by firm's financial policy. Okay, so as we discussed, that firm's cost of equity rises when it increases its use of financial leverage, because the financial risk of the equity increases while the business risk remains the same. So far we talked about the capital structure theory without taxes. Now let's talk about corporate taxes and capital structure. Debt has two distinguishing features that we have not taken into proper account so far. Okay, first, as we have mentioned in a number of places in the previous chapters, that interest paid on debt is tax deductible. This is good for the firm. It may be an added benefit to debt financing, right? So that's the benefit of using debt. You pay interest, so that reduces your tax benefit, liability, so you get some tax benefit. The second, however, is failure to meet debt obligation can result in bankruptcy. So this is not good for the firm, and it may be an added cost of debt financing. Okay, since we have not explicitly considered either of these two features of debt, we may get a different answer about capital structure once we do. Okay, accordingly, we consider taxes and here, and we will be discussing more about bankruptcy in our next video. Most of the developments from research in this area has been based on a classical tax system. So we will first discuss this classical tax system, and then we will also talk about the effect of taxes in an imputation tax system, which prevails in Australia and New Zealand. First, we start by looking at what happens when we consider the effect of corporate taxes on the firm and ignore the tax position of the shareholders. To do this, we examine two firms. One is Firm U, okay? One is Firm U, and another is, which is unlevered firm, and another is Firm L, which is levered firm. These two firms are identical on the left-hand side. Left-hand side, as I already mentioned, left-hand side of the balance sheet, that means asset side. So their assets and operations are same. We assume that both of the firm has an EBIT of expected EBIT of $1,000 forever. Okay, the difference between the two firms is that Firm L has issued $1,000 worth of perpetual bond, and which L means levered firm. It has issued $1,000 worth of perpetual bonds on which it pays 8% interest each year. So interest payment is $80 every year. And we assume that the corporate tax rate is 30%. Okay, and you can see that the income statement of these two firms are this. Okay. To simplify things, we assume that depreciation is 0. We will also assume that the capital spending is 0 and that there is no addition to net working capital. In this case, the cash flow from assets is simply equal to EBIT minus taxes. Okay, so cash flow is EBIT minus taxes. So firms U and L does have, you can see that their profit is 700 and 644. Okay, but if we add EBIT, if we deduct taxes from EBIT, then we get the cash flows. Okay, so you can see the cash flows are 700 for Firm U and 724 for Firm L. Don't forget, what we have seen here is the profit, okay, 700 and 644. And what we see here is the cash flow, so EBIT minus taxes. Now we immediately see that the capital structure is now having some effect on the cash flows, because you see that the cash flow are not same. Even the two firms are identical. Firm L, which is the levered firm, has a higher cash flow. Okay, higher cash flow, and you can see that if we look at the cash flow to the shareholders, it's 706.44, and total is 724. Now you might have realized by this time that the levered farm, the farm that is using debt, it has a cash flow of $20 higher. Now, have you wondered that why this is $20 higher? This is $20 higher because if you remember previously that due to payment of the interest, its tax liability was $24 lower. That means it paid $24 less tax. Okay, and that's why its cash flow to its capital provider is $24 higher. That means it's paying lower tax, so cash flow available is higher. Okay, so you see that the levered farm had this perpetual debt, so the same $24 tax shield will be generated every year forever. Okay, the after-tax cash flow to levered farm does be the same. Flow to L will thus be the same 700 that UN earns plus $24 tax shield. So which means that for levered farm, the cash flow is 700 that is earned by the unlevered farm plus this $24 tax shield. Since L's cash flow is always $24 greater, farm L is worth more than farm U by the value of this $24 perpetuity. You understand? So levered farm has $24 cash flow higher. It always, as a result, this farm will have a higher value than the farm U. Because the tax shield is generated by paying interest, it has the same risk as the debt. And if we use the cost of debt as the discount rate, the value of the tax shield will be, this is a perpetual cash flow. So you know the formula for perpetual, to find out the present value of perpetual cash flow, that will be $300. Okay. So far what we are discussing, the value of a levered farm is value of an unlevered farm plus present value. So this present value of the tax shield is $300. Okay. As a result, since it is the present value of the tax shield is a positive amount, so we now come up with the famous result of Proposition 1 with corporate taxes, that value of levered farm will be higher than the value of an unlevered farm, because value of a levered farm will be equal to the value of unlevered farm plus the tax shield. Okay, so you can see it here that this is the value of unlevered farm, and this is the value of levered farm, which is value of unlevered farm plus taxes. So value of a levered farm should be higher. Okay, so the effect of borrowing in the case that we have been discussing is well illustrated in this figure 13.4. So you can see that here we have the value of levered farm in the left-hand side and the debt in the left-hand side, means in the vertical axis, and we have total debt in the horizontal axis. Okay, so Proposition 1 with corporate taxes implies that the relationship is given by the straight line with the slope TC. Okay, so this is what we are talking about, the slope TC. So you can see that as the total debt increases, the value of the unlevered farm remains the same because it doesn't have any debt. And the value of the levered farm start increasing as we use more and more debt. Why? Because as we use more and more debt, we get tax advantage. Okay, we get tax shield, and this present value of tax is added to the value of unlevered farm. So value of levered farm is start increasing as we use debt. So with more and more debt we use, the value of a levered farm will be higher. Okay, now let's come to the point that we discussed so far is the classical tax system. Now let's discuss a little bit about the capital structure and dividend imputation. Remember that Proposition 1 without taxes concluded that capital structure did not add value to the farm, therefore was irrelevant. In Australia and New Zealand, as in many other countries with dividend imputation system, the imputation process has the effect of offsetting the effect of company tax. So this is almost the proposition 1 without taxes, suggesting that the capital structure should not affect the value of the firm. Okay. However, there are a number of differences between the proposition 1 no tax situation and proposition 1 a dividend imputation system. Okay. Imputation system prevents us from concluding that capital structure is irrelevant. Okay. First, company tax is actually paid by the firm under a dividend imputation system, while the government refund is effectively delayed until the shareholders actually get to utilize the associated tax credit. Okay. As a consequence, there is a timing difference during which the government is enjoying an interest-free loan from the company shareholders. Okay, so which means that, try to understand this point, that the government receives the taxes, okay, from the company, which is refunded back to the shareholder, but at a later time. So it can use this fund for other purposes. Okay. Second, the rebate of company tax is only for resident shareholders and tax paid on resident company profits. This means that firms with large overseas operations are unlikely to be able to pay fully franked dividends, and firms with overseas shareholders will not be able to tax advantage of a portion of the imputation credit. Okay, so for example, in chapter 12, we use the illustration of Australian company Coca-Cola Amatil, which has a substantial shareholder, the Coca-Cola Company of the United States. The Coca-Cola US is unable to take advantage of Coca-Cola Amatil's Australian frank dividends. Okay, so the end result is that the debt finance still enjoys a small tax advantage under an imputation system, but much less than in the case of a classical tax system. So these are the 2 points that I have discussed. So that's essentially the end of our discussion on capital structure theory. First of all, without tax, and then with taxes in a classical tax system and imputation system. So this is essentially a summary of the structure theory that we discussed so far. So that's the end of our discussion on this video. Thank you very much.